Can a country facing security pressure choose ownership over dependency? Burkina Faso believes it can, and it is proving it quietly. While the country navigates instability and international scrutiny, it is not announcing dramatic nationalizations or staging confrontations. Instead, it is working through legal procedures, ministerial approvals, and structured negotiations to increase its stake in one of its most important gold projects. At the center of this shift is the Kiaka Gold Project. Originally, the ownership structure was straightforward. West African Resources, WAF, held 90%, while the state of Burkina Faso held 10%. That model reflected a common framework across Africa's mining sector. Foreign capital assumes financial risk, operates the mine, and the host country receives royalties plus a minority free-carried stake. On paper, it seemed balanced. But balance depends on perspective. For foreign shareholders, 90% meant control, dividends, strategic authority, and long-term exposure to rising gold prices. For Burkina Faso, 10% meant limited influence, limited dividend share, and dependence on taxation and royalties to capture value. Then production surged. In 2025, Burkina Faso recorded 94 tons of gold production, its highest output in history. Gold is not symbolic wealth. It is liquid, globally priced, and strategically valuable. When production expands rapidly, ownership ratios become more visible. 90% of a growing asset carries far more weight than 90% of a stagnant one. That is where the logic begins. If output is rising, if global gold prices remain strong, if operations continue despite regional instability, then the mine is not fragile. It is durable, and durable assets invite renegotiation, not abandonment. After 2022, what changed in Burkina Faso was not just leadership. It was posture. In 2024, the country updated its mining code, increasing the state's free-carried equity from 10% to 15%. That reform created a new legal baseline across the sector. Companies operating in the country, including West African Resources, adjusted to the new framework. This matters because once the legal architecture evolves, discussions about additional equity no longer appear radical. They become extensions of existing law. The Kiaka conversation did not emerge in isolation. It followed a sequence: revise the code, strengthen oversight, demonstrate record production, then examine deeper ownership. And throughout this process, something critical happened. Nothing collapsed. Operations at Sanbrado and Kiaka continued uninterrupted. There were no shutdowns.
No dramatic investor exits. No arbitrage dominating headlines.
Instead, discussions moved through institutional channels, particularly through the state mining entity Sopaman. Draft decrees were reviewed. Ministerial approvals were examined. Boardroom conversations replaced confrontation. Procedure, not panic. Western commentary often simplifies such shifts as resource nationalism. But instability usually looks different: production collapse, asset seizure, legal warfare. None of that occurred. Instead, the government examined securing an additional 25% stake in Kiaka within legal boundaries. The real question is not whether the original 90-10 structure was legal. The real question is whether it still reflects national interest when production reaches historic highs. Countries struggling to maintain output rarely push for structural adjustments. They focus on survival. But when production is expanding and commodity prices are strong, confidence grows. The conversation shifts from, how do we attract investors, to, how do we rebalance value distribution? Burkina Faso strengthened its leverage not through rhetoric, but through regulation. In recent years, the government tightened oversight of gold exports and consolidated state-linked purchasing to combat smuggling. Historically, illicit gold flows have drained revenue across West Africa. By centralizing oversight and improving transparency, the state gained clearer visibility into production volumes and revenue flows. Clarity changes negotiations. When a government knows exactly how much gold is produced and exported, it can model long-term dividend projections under different ownership structures. It can calculate what an additional 25% stake might yield over decades. Production plus control equals bargaining power. That is why Kiaka became the focal point. It is not a small exploratory site. It is a projected megamine with long-term production potential. Adjusting ownership there would materially affect future dividend streams without destabilizing the entire sector. Notice what did not happen. Other projects operated by West African Resources were not immediately targeted in the same way. This selective approach signals calibration, not blanket expropriation. When governments want to reshape an industry, they do not shake the entire system at once. They choose a strategic asset, large enough to matter, structured enough to negotiate. Kiaka fits that description. Timing also matters. Record production was already achieved. The updated mining code was already in place. The legal and operational foundation had been strengthened before deeper ownership discussions began. This sequencing changes market perception. Assertiveness backed by performance is viewed differently than assertiveness born from crisis. There was also an earlier precedent that reshaped confidence in the sector. In 2024, a dispute involving Endeavour Mining and Lilium Mining ended not in collapse but in a negotiated settlement. Ownership adjustments were made, financial terms were agreed upon, and compensation structures were established. The outcome was structured, not chaotic. That episode demonstrated something important. Ownership structures are not permanently frozen. They can evolve within legal frameworks without severing international ties. Production continued afterward. The country remained part of global gold supply chains. That continuity reduced fear. If a state can renegotiate and still maintain stability, then the assumption that contracts are untouchable begins to weaken. Kiaka is unfolding in that post-precedent environment. But beyond legality and precedent lies a deeper strategic choice. Equity versus taxation. Raising taxes is immediate. Increasing royalties is visible. Expanding equity is structural. Taxes fluctuate. Royalty rates can change. Equity embeds the state inside the asset itself. When a state holds equity, it earns dividends. Dividends scale with profitability. If gold prices rise, dividend flows rise. If efficiency improves, returns grow. Equity aligns incentives. Royalties guarantee income per ounce. They do not guarantee influence over corporate decisions. Equity opens access to governance, long-term planning, and strategic expansion discussions. It transforms the government from an external collector into a participant in value creation. Mega gold projects operate for decades. Even modest adjustments in equity can compound significantly over time. In a region managing security expenditures and shifting geopolitical alignments, autonomous revenue becomes strategic insulation. Dividend flows tied to sovereign equity reduce reliance on external financing and conditional lending. They expand fiscal breathing space. Globally, resource-rich states often prefer equity models. Sovereign participation in energy and mineral assets is common elsewhere. The financial logic is consistent. Ownership secures long-term leverage. The difference lies in narrative framing. When wealthy states retain equity in strategic sectors, it is called prudent management. When African states pursue similar adjustments, it is often labeled nationalism. Yet, the economic principle is identical. If Kiaka's equity expansion proves sustainable, if production remains stable, investors stay engaged, and state revenues increase, the implications will extend beyond one mine. Successful policy travels. Across the Sahel and West Africa, governments are re-examining extractive contracts signed under different historical pressures. Mali has revised its mining code. Niger has recalibrated resource agreements. Kiaka matters not because of confrontation, but because of calm. There has been no mine closure, no investor flight, no international legal explosion. Instead, there has been structured engagement and public statements describing discussions as constructive. That calm challenges a long-standing warning. Increased state ownership and capital disappears. So far, capital has not disappeared. If expanded participation can coexist with operational continuity, the assumption that sovereignty and investment are incompatible begins to dissolve. For younger policymakers and analysts across Africa, This is not about isolation from global markets. It is about recalibration within them. It is about renegotiating ratios. If dividend flows increase over time, they can support infrastructure, security stabilization, and domestic value addition. Greater equity can strengthen leverage to encourage downstream processing instead of exporting raw material indefinitely. Control at the mine level influences control across the value chain. Kiaka becomes proof of concept. If the model holds, equity becomes part of standard negotiation rather than exceptional demand. The baseline expectation shifts. The gold remains in the ground. The global market remains accessible. Investors remain present. What changes is who participates in long-term value accumulation. So the debate is no longer about whether 25% is too much. The real question is this: if a country can expand ownership legally, peacefully, and profitably without isolating itself from global capital, how many other contracts across the continent will begin to look negotiable? That is the recalibration unfolding in Burkina Faso. Quietly, procedurally, strategically,